Hi everyone, my name is Shang Chou. A quick background on myself. I have spent about 2 decades working on Wall Street and in the financial services industry in the United States. My formative years were at PIMCO in Newport Beach, multi-trillion-dollar fixed income manager. I also spent time previously at JP Morgan and Goldman Sachs. My recent work has really been focused on building innovative investment products for investors of all sizes. About 5 years ago, in the depths of COVID, I joined a set of former PIMCO colleagues to help build a company called Simplify Asset Management. Today, Simplify is just under $7 billion in assets or so, and the focus there was on delivering innovative investment strategies in the ETF wrapper. I've also spent time at a London-based investment firm called Tema. The focus at Tema is really on institutional-grade active equity strategies. And so we have some really great portfolio managers in-house who are delivering what are traditional hedge fund equity strategies within a low-cost, tax-efficient, transparent ETF wrapper. One of the questions we hear a lot from investors is, what is our view on markets, for the coming year? Well, I would be the first to say, we don't have a crystal ball, and we would never claim that we can predict whether stocks are going up or down. I do think there are a couple areas that we should be focused on for at least the next 12 months or so. One, we've seen a stark shift with the Trump administration. Prior to this, there was sort of an implicit understanding that there was a government put, whether it's through the Fed or through other political entities, that there was sort of a put that was being underwritten within the equity markets. We've seen a pretty dramatic shift with the Trump administration where the focus has not been really on supporting the equity markets and more on enacting certain changes within fiscal policy, whether it's through the Department of Government Efficiency, or really trying to get our handle around some of the illegal immigration issues that are going on in the United States. Second of all, we observed that in the past, equity markets run up in a way that the concentration within the top, call it 7 or so names, is at a pretty much unprecedented level since the 1800s. And so typically what we find is most investors are overexposed to names in the Mag 7. So when I really take a step back and I think about it, I think it's an opportune time for investors to really examine their asset allocation as well as their equity exposures. We see investors underallocated to certain sectors. These things might be, parts of healthcare and life sciences, specifically biotech. Many names in biotech are either trading close to or at even below, net book value of cash. Other parts of the market that we see are underallocated often are mid-cap stocks. And there's always the free lunch of diversification. So other asset classes, whether it's alternatives or parts of the fixed income market, might be pretty interesting and compelling to look at this time.